Everyone is on mute. Dr.
Professor Singh, what time is my talk? What time is my talk?
You were speaking around 11:30.
And how much time do I have?
15 minutes.
Okay.
And then we'll have short session of question answers and we'll wrap up by 12 noon. So we'll be meeting the times.
Please go ahead, sir. We are live now.
So I want to welcome everybody to the special session of productive use of financial resources, roadmap for economic rebound. This is an important topic. As you know, the country has had series of COVID attacks. The second wave is over and the third wave is being discussed about. During this phase, which has lasted more than a year, the economy of the country has been little slower than it should have been in the normal times. The financial resources that are available for us to achieve the recovery and rebound, the country having its potential and waiting to grow to a $5 trillion economy earlier than anything else. The Prime Minister's vision that we have to grow to a $5 trillion economy suddenly suffered a setback because of the global pandemic. While the Ministry of Finance worked extremely hard to revive the economy during different phases of COVID, the Reserve Bank also played a prominent role. In this whole process of recovery and the rebound, SEBI, the stock market regulator, has also been playing a very prominent role. Today, we are very fortunate and we are very lucky and honored that the Chief Economic Advisor of Government of India is going to be speaking to us by 11:30, and the whole-time member from SEBI is with us to speak to us today, discuss how the financial resources are helpful, can be used, deployed to revive the economy. As we all know, the economy has been facing challenges and financial resources for sure are being provided, but the absorption capacity is missing. The demand is an issue. The government, the Reserve Bank, SEBI have been making efforts that the industry finds it easier and the resources are available to them easily and liquidity provided in the markets. It is in this context that one cannot miss the role of the non-banking finance companies, the role that the MSMEs play in our country, and all the institutions that I've mentioned have been playing a prominent role to ensure that resources are available to all of them. Various announcements by the finance minister have been made at different points of time to ensure that the industry, be it large, be it the small, gets the benefit. To sustain demand, the government and the RBI have also played a prominent role and asking the banks to provide loans where they're needed the most. Mudra loans is one such example. Foreign institutional investors have found India a lovely destination with a very bright future. The foreign direct investment, FIs flows in the country has been regular. The stock market has also been achieving dizzy heights, which shows that the global markets and the domestic investor has immense faith in the regulators and the Indian markets. Today, to discuss all these things, as I mentioned, we are very fortunate to have the Chief Economic Advisor speak to us and former RBI person, Mr. Mahalingam, also member from SEBI, speak to us. Before we go to them, I'm now going to invite our Secretary General of ASSOCHAM, and I must thank the ASSOCHAM for thinking about such important topics and organizing such events for the benefit of all. So I invite the Secretary General, Mr. Deepak Sood, to come and share a few thoughts and words with us. Mr. Deepak Sood has been in the industry for nearly 26 years, and he has worked in all important industries like Larsen and Toubro, ABB, and he has also had a stint at CII. With that, I'll invite Mr. Deepak Sood. Mr. Deepak Sood, please.
Thank you very much, Dr. Charan Singh. Namaskar to everybody. Dr. Subramanyam, thank you. Mr. Mahalingam, thank you very much. Ashwinji, Vinitji, thank you very much for joining us this morning. I think the timely actions that the government has taken during these troubled times, the testing times of COVID, have been really apt, and we've kind of, not overdone, underdone, but I think it has come the right things at the right time. And I think the rural economy support, the reforms that have come through have been really, really nice, and must compliment the government for the forward way of thinking and ensuring that we are all safe. So I think going forward, the way they have the PLI schemes, how they are going to fund the growth for this country, import substitution, so that we create our own jobs and our own material is first utilized rather than letting people sell to us. Our markets are our strengths, and therefore this whole piece that has been developed by the government is really, really going to help. Dr. Charan Singh has already spoken about the fiscal and the monetary balancing that the country has done. I think it's a beautiful way with which it has been dealt with, and I compliment both the sides, the financial side as well as the RBI side, for actually helping us. And obviously, SEBI has been the most important thing, because today avenues of investments, and I was looking at the NAC report which said the number of people who have added to the accounts who are now first-time investors in India is very, very large, and very heartening to see that more and more public money is getting participated and more IPOs coming in. So more low-cost funding is available to people, and the stress on the banks therefore becomes as much less. And that's another way of looking at things. I think the key piece is going to be vaccination, and I think business continuity and resilience of business is very, very important. And I think the government needs to ensure that the December target that has been done is a must. I want to caveat here, which is very, very crucial, is vaccinating the 12 years and above. If we have a hit at that age, what we would find is that we would find the workforce being hit very badly. Not only the child hits, it also has a parent, and the two parents work, and therefore that would be a very major hit for the business side. So therefore this has another angle which one needs to really look at. The government is really spending money on enabling environment for health and stuff. So this is something which ASSOCHAM is very, very keen, and we're working with the government to ensure rural infrastructure is also complemented and enhanced in the whole piece. I think finally the point that I would want to make is Dr. Charan Singh ji spoke about availability of liquidity for funding, but there is a lot of MSME who still struggles to receive that liquidity, and for the right reasons, the wrong reasons, we will still have to support these people who are struggling, especially in the sectors which have been the worst hit by the pandemic, which is the tourism, the hotel, the services industry, is something which is really, really struggling right now. I think the demand side is something that really bothers us. In terms of supply side, things have been done, but if the people don't have the buying power, or the number of people are not able to stay above that level. So if you were talking about per capita of about $900 to $1,800, we will have to put our minds together to ensure this per capita income of the people, so that we can go to higher consumption rates, is something that one would also want to look at. So basically, the case that I'm trying to build up is we are extremely positive at ASSOCHAM, whether the large, medium, or small, the future of India is secure. And I think very, very sound hands, and the opportunity that exists for us is large. And we will see that this $5 trillion economy, as the Prime Minister did show to us, is achievable. May not be in 2024, 25, but definitely year beyond, we will actually go back to our double-digit growth. And that's what I had to say. Thank you very much, Dr. Charan Singh. And once more, Dr. Subramanyam and Mr. Mahalingam, welcome to this event of us. Thank you.
So thank you so much, Mr. Deepak Sood. And now I would like our president of ASSOCHAM, Mr. Vineet Agarwal, to speak. He is the MD, Transport Corporation of India. And I'm very happy to announce he's from Carnegie Mellon. And also in 2014, he was awarded the Young CEO of the Year by CEO Magazine. I think this is something very, very important. And so in 2017 also. So he was named among 200 young entrepreneurs nominated by Government of India under the Champions of Change initiative, and he was awarded the CEO of the Year 2018 by the Indian Institute of Material Management. He's our president of ASSOCHAM, and I would invite him to come and welcome our guest and share his thoughts.
Thank you, Dr. Charan Singh. A very good morning to Dr. Subramanyam ji, Shri Mahalingam ji, Shri Ashwin Parikh, Deepak Sood, and all the dignitaries who've joined us today to listen to the eminent Dr. Krishnamurthy, the Chief Economic Advisor for Government of India. The impact on businesses during this period of the pandemic has been quite profound, with supply chains completely disrupted or broken in the first wave to demand unpredictability in the second wave. All businesses have faced immense challenges. Even businesses that are doing well have faced challenges of inventory, managing new channels of distribution, to human resource constraints. Of course, there are many others that are struggling, especially the MSME sector, and in the services area, especially in hospitality, tourism, etc. Clearly, this start, stop situation has created major issues in capital flows, labor management, order processing, amongst other issues, thus compounding problems related to capacity utilization and future investments. The runaway commodity prices have certainly not helped this section of the industry as well. When we look at various ways to deal with these challenges, the most important factor in order to build confidence in consumer sentiment is vaccination. As our country expands coverage, we will see a marked change in behavior, initially perhaps even the undesired type, which will kickstart a recovery process. Notwithstanding, a specter of the third wave is reducing some of the optimism as households tend to direct their savings towards healthcare. The special allocation made by the government for augmenting the health infrastructure, ICU beds, oxygen supply, amongst others, will definitely build assurance. To kick off the demand cycle, fiscal relief to consumers in any form would help. From direct cash transfers to the people at the bottom of the pyramid to targeted tax concessions can help build spending confidence. This, along with the support to industry, especially the MSME sector, as announced by the Honorable Finance Minister through various packages, can help tide over many constraints and challenges they face. It is very critical that the government front ends this recovery process with expenditure. Clearly, health is one of the ways. However, infrastructure spending has the highest trickle-down effect on the economy. A forceful and sustained push towards this will activate many levers of the Indian economy. The challenges facing the government are immense, from lower tax collections to higher expenditure, especially in the social sector. The stress faced by many financial institutions is also immense. Clearly, financial stability is a crucial underpinning for economic development and financial inclusion. The robustness and resilience of financial institutions are as significant as that of its financial systems and markets. If an NBFC or a cooperative bank fails, its customers may tend to lose faith in the broader financial and banking system as well. Amongst the many ways of dealing with this crisis and moving towards an economic rebound followed by sustained growth, the optimal use of financial resources to drive this agenda would not just be critical, but also very significant. An enhancement of investment levels, both public and private utilization of best resources through the financial lending and alternative sources of funding. This would imply an overall increase in fiscal expenditure, along with a shift in composition towards higher public investment for the delivery of public goods and services. Countries that have successfully sustained high growth rates did so by setting up growth promoting government institutions to coordinate public investments, while also incentivizing the private sector to find this kind of investments for a growing and dynamic economy. The role of the banking sector would be crucial, from having the scale to the right balance under the right framework between banks and other non-bank credit providers. Globally, the bond market is regarded as the largest and the deepest source of capital for companies. In India, the real sector consisting of the NBFCs has very small dependence on bonds, therefore, thereby making it heavily reliant on bank and shadow bank credit. A robust capital market also creates attractive opportunities, as well as an attractive business environment competes very strongly with FDI that is floating around the world. Privatization is another step in direction towards raising resources for sustained recovery. We should move away from simply selling of assets to creative financial planning, where government is not an owner, but perhaps remains an investor. As we move towards our journey for a $5 trillion economy, we need to be aggressive, creative, and bold in our thinking and actions. We are confident that with this help of government's reform and regulatory measures, we will definitely achieve our dreams. Before I end, I'm reminded of a quote by Nelson Mandela: "May your choices reflect your hopes and not your fears." With these words, I would like to conclude my address and now request Dr. Charan Singh, our moderator, to kindly take forward this discussion. Thank you and Jai Hind.
Thank you, Mr. Agarwal. And now I think it's time to release the knowledge report. So, and then of course, I'm going to invite Mr. Ashwin Parekh, the managing partner of Ashwin Parekh Advisory Services, to tell us the highlights that are in this knowledge report. And as you can see, the knowledge report is exactly on the topic that we are doing the seminar on: productive use of financial resources, roadmap for economic rebound. With this, I invite now Mr. Parekh to tell us the highlights that are in this report. I must introduce Mr. Parekh. He was earlier with EY, and he was the senior partner there and heading the financial services division until June 2013. I was having a word with him. Since then, in the last 7-8 years, he has released multiple knowledge reports and also educating people on the boards of various banks. With this, Mr. Parekh, can you please share with us the highlights of the report? And we would request you to be brief and pointed, please, just because of the time.
Yeah, thank you, Dr. Charan Singh. So quickly, the report, when we were preparing, we sort of, decided to work it out in 3 parts. One is the various government schemes, and the impact of those in terms of making the financial resource available to the industry, to the business. The second one, so we've covered all the schemes, under the report. The second one touches upon something very interesting, and it talks about ESG as a concept, the sustainability, because we're talking about sustainability in the Indian context. And if the financial resources which are deployed have to really pay back, then sustainability does become very critical. So there is a short coverage. And the third one is the most critical one. And that actually talks about the productive measures. That is, how do the lenders and the borrowers ensure that there is a productive application of financial resource? So the report covers all these 3 parts. The first part, I'll quickly talk about the various schemes. As far as the Emergency Credit Line Guarantee Scheme 1 was concerned, the report talks at length about the amounts which are made available by the government. So, and I must admit that this stimulus program of 9 lakh crore of rupees, overall 20 lakh crore of rupees, was particularly unique. You do not find such a program in many countries. It was a very nice intervention, a timely intervention on the part of the government. Then, of course, came the RBI, a COVID-19 stress resolution kind of program. I was very fortunate. I was a member of the KV Kamath committee, and under that committee, it gave the report in financial parameters under which COVID-19 stress resolution can be conducted. Glad to share that the report was totally accepted by the regulator, and then the regulations around COVID-19 stress resolution was announced. And then we were equally at the committee so pleased to note that the government had decided to accept the report as an underlying report for the release of the Emergency Credit Line Guarantee Scheme 2, which came up after the RBI sort of regulations. So that was the experience. It was a unique experience, and I'm very fortunate that I could really be a part of it. When it came, however, to the evaluation of the performance of these schemes, then, and the report talks about it, there was a bit of a gap between what was expected and what actually did happen at the ground level. Out of the 9 lakh crore, for example, what has so far been sanctioned by the banking system is of the order of about 5 lakh crores. So which means the industry and the borrowers have not utilized that. The same thing has happened with even the COVID-19 stress resolution program of the RBI. We had estimated about 3.5 to about 4 lakh crore of release of funds from the banking system, vis-a-vis against which only about 1.85 lakh crores has been utilized. So somewhere along in the financial resource availability, both the borrowers and the lenders have not really looked at what was available to them, what was really essential to relieve the pain at the grassroots level. I would say both of them should have really done it. Unfortunately, that has not happened, but be it so, going forward, at least this becomes a nice imprint or a nice method of really taking the economy forward through platforms like ASSOCHAM. It's important that the word is spread out to the borrowers, particularly MSMEs, to use these schemes more effectively, and that's what ASSOCHAM does regularly. Thank you, Dr. Charan Singh.
This is an excellent summary, Mr. Parekh, of the report, and I would look forward to reading the report now. I'm now going to invite our special guest and a dear friend, Shri Mahalingam, whole-time member of Securities and Exchange Board of India since November 2016. Mr. Mahalingam was my colleague at the Reserve Bank of India for many years. He has worked in various departments of the Reserve Bank. He was the regional director also, and he's from IIT Kanpur, and he has an MBA from Birmingham Business School. Excellent work that he does and the recognition of his services are known to all of us. I would now invite our special guest, Mr. Mahalingam, to share his thoughts with us. Mr. Mahalingam, please.
Thank you, Dr. Charan Singh. Dr. Krishnamurthy Subramanyam, Chief Economic Advisor. Shri Vineet Agrawal, President of ASSOCHAM. Shri Deepak Sood, Secretary General of ASSOCHAM. Shri Ashwin Parekh. I am very happy to be here at the invitation of Dr. Charan Singh to share a few thought process as far as SEBI's work is concerned during these difficult times. I'm not going to take too much time on it, but on one subject, I'm going to spend a little more time, that is a corporate bond market. SEBI during this COVID times has been initiating a large number of measures to alleviate the sufferings of the listed companies. And these measures have been in the form of relaxations in terms of compliances, relaxations in terms of fundraising, relaxations in terms of facilitating right issues, etc. I'm not again covering the exhaustive list. All that I wanted to mention is SEBI has been quite proactive in these difficult times to ensure that the market entities do not suffer because of lack of funding. And simultaneously, we have seen at the same time, the REITs and InvITs as instruments have picked up a lot of traction in the last couple of years, again thanks to a constant review by SEBI to relax quite a few things. And the IPO space has been really gaining a lot of traction in the current year, as all of us are aware. And we also see, which our chairman has been stressing on a regular basis, the phenomenal number of demat accounts which have been opened in the last about 1.5 years, culminating in the last about 3 months, where there has been a record opening of the demat accounts. One small point that I would like to stress on here is there has been a lot of talk about a disconnect between the stock market and the corporate performance. I won't really say so. I would like to put it across as the stock markets actually move on expectations. So while there was a crash in the market in the month of March, last week of 2020, subsequently, I think the market has been factoring in over a period of time a good amount of growth. And today we do see that the corporates are putting up a reasonably good performance. And to add to that, of course, as many of the speakers mentioned, and Dr. Charan Singh also mentioned right at the beginning, the Reserve Bank has been pretty supportive in the whole scheme of things by injecting sufficient amount of liquidity in the system. Some of this liquidity might have found its way into the stock market, and that's one reason why the stock markets have gone up with abundant liquidity. The number of demats account open is a very positive sign from the angle that, okay, the retail investors are gaining a heft as far as the market is concerned. In fact, we got to see in the last about, say, 5-6 years that whatever has been happening to the stock market from the FPI side is not the sole mover of the market, and they have been counterbalanced, they have been adequately, supplemented or supplanted by the domestic financial institutions. Now, today we find a third pillar developing, that is of the retailers, and these retailers are going to play a very important role. Only thing is, we are hoping that these people come into the market with a full amount of awareness about the risk. Now, this is a general introduction that I wanted to give, but for about 5 minutes, I want to focus on the real theme about the economic rebound and where perhaps SEBI is now today concentrating on, about the corporate bond market. Now, we all know that banks are actually becoming a little, finding it difficult to extend long-term funding in the current circumstances for a variety of reasons. We know the ALM mismatches that the banks face. We also know currently that the banks are actually overburdened by the overhang of the NPAs in the system. So exit banks, I'm not saying that they are completely out of it, but the banks are not able to do their job to the extent that they are expected to do. Now, there is one section which is now arguing for the DFIs to come back. I'm not sure whether the DFIs are going to come back or not, but certainly what needs to be developed in the country in a big way is the corporate bond market. This we have been talking about for quite some time, but I see a flurry of action which has been taking place in the last about, say, 8 months to 9 months, where the government has also been playing a very proactive role. The Reserve Bank has also been playing a good role. SEBI has initiated a few measures. Some of this I would like to outline and close my address. Now, the corporate bond market outstanding today is close to about 36 lakh crores. In terms of percentage of GDP, this is about 18%. While it looks a little big, while the percentage looks healthy, but if we really compare with US, where it is about 124%, where we compare with South Korea, where it is well in excess of 50%, Brazil, where it is close to about 70%, I think they are lagging far behind. So the corporate bond market has to play a very important supportive role for the economic rebound, for the GDP growth of the country in a very big way. The annual issuances of the corporate bonds today is at a healthy level of close to about 7 to 8 lakh crores. No doubt, a good part of the bond market that gets crowded out by the government issuance of close to about 14 to 15 lakh crores, that crowds out all the corporate bond market, no doubt about it at all. And the corporate bond market, as far as the character of the bond market is concerned, is dominated by BFSI, which means the manufacturing companies and servicing companies have not been able to really come into this area. They continue to depend upon the bank as a source of capital. Now, this is something which has to change over a period of time. Now, this I'm talking about from the issuer side, but then if we look at the investor side also, I think there are quite a few things which need to change. And if these changes do not take place, perhaps we cannot really hope that the corporate bond market is going to gain traction. On the investor side, the biggest class of investors in the corporate bond market is the mutual funds, the insurance companies, the provident funds and pension funds, banks to a small extent, and others to a small extent. there are still a lot of regulatory restrictions on many of these entities entering the corporate bond market. SEBI, for its part, as far as the mutual funds are concerned, they are allowed to invest in any of the investment grade bonds. They are not allowed to go below the investment grade, but up to investment grade, they are allowed to go. Whereas when it comes to the insurance companies and pension funds, generally they stick to the AAA rated bonds. There is a need, while actually there have been some relaxations on the regulatory side, I think the insurance companies are still not, prone to take a little extra risk. The insurance companies have a huge amount, a liability profile, which extends over a space of time. So they are well positioned to take this kind of a risk. I know credit risk is a very difficult to measure. Credit risk is the most difficult of the risk to measure. But then I would still say that the provident funds and insurance companies have to be a little more forthcoming in this area. There are other areas where perhaps the other regulator will have also to play some proactive role. Now, till this day, in the RBI's liquidity adjustment facility, the corporate bonds are never accepted as collaterals at all. It's not legally enabled, no doubt about it at all. But then legal enablement is not a very big problem. I think one has to take it up with the government and you have to come up with a good rationale and it could be amended. Now, one important positive fallout of this, if RBI is going to accept at least some AAA rated bonds as collateral, is that there is a ready market which is available. Now, today, this is not accepted as a part of LAF. This is not even enshrined as a part of the statutory liquidity ratio. The statutory liquidity ratio only takes into account the government bonds. Now, this is something where we need to have a rethink. I'm not saying that go down the credit curve and take the junk bonds, but at least we can start off with the top rated bonds as far as some of the XLR eligibility is concerned. Even LCR, the liquidity coverage ratio, while the Basel guidelines provide for the AAA rated bonds to be included there, today the banks are flooded with the government bonds, whether it is the central government bonds or the state government bonds, so they hardly ever take this as a part of the liquidity coverage ratio. Again, this mentality will have to undergo a huge amount of change. Now, in the corporate bond market by itself, a lot of good work is today being put in from the government side and the SEBI side to build up a vibrant secondary market. We realize that one of the important pillars of a vibrant secondary market for the corporate bonds is going to be the repo market. So we have been talking to the government as far as having a repo clearing corporation is concerned. We have had a lot of talk with the asset management companies who are willing to bring in the initial funding for the repo clearing corporation. Once you have a good repo clearing corporation, the repo market would gain a lot of traction because the credit risk vanishes out of the horizon and there will be a central counterparty settlement. The government has been proactive enough in the budget to come with a kind of a backstop facility, which would actually be getting activated in times of liquidity crisis where the bond market completely freezes. The government has come up with a measure where actually that they will be kind of purchasers of these bonds. We are now working very closely with the government to ensure that, okay, this takes off in a big way. Now, these are some of the measures where perhaps all of us as stakeholders will have to work together to bring up the corporate bond market. And I continue to repeat, without the corporate bond market gaining traction, perhaps the funding sources to depend on banks as exclusive funding sources is not going to be a positive thing at all. Thank you very much for this opportunity.
Mr. Mahalingam, I must thank you for bringing such important topics on the table. I totally agree with your conclusion. A well-developed bond market is so important for the growth, especially of the infrastructure. I thank you for your time. I remember you were telling me it's such a busy day today, and despite that, you agreed to our request and speak to our participants. Thank you once again. I would now like to invite our chief guest, Dr. Krishnamurthy Subramanyam, who has a PhD, my dream PhD, a PhD from Chicago Booth, and then is a professor at the Indian School of Business, Hyderabad, professor of finance. He is the chief economic advisor of our country, youngest, I'm sure, since December 7, 2018. Each of his economic surveys is a masterpiece and full of ideas, and I think they have been so well received in our country. We are passing through a very difficult and challenging phase, once in 100 years, and he happens to be our chief economic advisor during this difficult stage. We welcome him to share his thoughts with us today. Dr. Subramanyam, please.
Thank you very much, Professor Charan Singh, and very good morning to all the eminent dignitaries on the virtual dais and everybody who has assembled here. Let me start by thanking the organizers for inviting me to share my thoughts. Let me take off from the very nice concluding thought that Vineet had mentioned, that our choices should be driven by hopes and not by fears. Let me, mention very, very clearly that if you look at the policy choices that the government has made, especially on the reforms, seminal reforms that have been done over the last year and a half, in the interest of time, I'm not going to go into the details, but there are, other fora where I've spoken about this. I'm sure all of you will agree that the government's choices are clearly driven by hope. Of course, a lot of commentary seems to be driven by excessive fear. So there is certainly the mix of the two parts that you mentioned in Nelson Mandela's quote. But I can definitely vouch for the fact that our choices and my own assessment, if you will recall, after the first quarter numbers came last year, when there was a decline of 24 odd %, I had gone on all the national channels and said that, by looking at the high frequency indicators that we track, almost 60 of them, there is a V-shaped recovery that is on. And we are very glad to note that that is indeed what has transpired at the macroeconomic level. During the question and answer session, we can talk about actually other letters. Some people talk about the K. I think, all that is fine. But at the macroeconomic level, after a 25, close to a 25% decline, then a 7.5% for Q2 and 0.4% for Q3 and 1.6% for Q4. As a result, India, as the only country among all large countries to have had 2 consecutive quarters of growth, I think is clearly illustrative of the V-shaped recovery, and therefore my assessment and my judgment that a lot of commentary seems to be based on excessive fear. There is no doubt that some sections, especially those that are poorer and some of the small and medium enterprises seem to be more impacted. But I think what we have to keep in mind is that most of these sections, unlike the organized sector, for them distress does not come from the balance sheet. In other words, financial distress, which actually leads to hysteresis, as macroeconomists talk about, is not an aspect that impacts them. As soon as the economy starts coming back, fully, those that depend primarily on labor, actually, for their production, actually can start immediately, and that was evidence that was seen in the fourth quarter as well. For those who are interested, I actually would urge you to go and read the May edition of the monthly economic report. The Ministry of Finance comes up with now a monthly economic report where this is clearly talked about. Before I speak on the financial sector itself, I must, as being part of the panel, there are 3 aspects that, of speakers earlier that I want to clarify, lest there are any misconceptions that prevail among the audience. First, I heard the word import substitution being mentioned. Let me be very, very clear that the Atmanirbhar Bharat initiative is not consistent with import substitution. Import substitution is something that we've been there, done it. Atmanirbhar, as we all know, in Hindi means self-reliant. And let me tell you that you show me a self-reliant individual, I'll show you a capable individual. You show me a self-reliant company, I'll show you a capable company. You show me a self-reliant country, I will show you a capable company or a capable country. What does that mean? That, basically self-reliance is built with capabilities, and capabilities are never built in a vacuum. Capabilities are built only by competing with the best. And those almost everybody, here among the speakers actually has had the opportunity to attend the best institutions and actually having competed with the best professionally, and therefore you will agree that capabilities are built by competition. So any misconceptions about about import substitution, etc., let me be emphatic and actually and dispel them right away. The second aspect, and again, actually, I think in both Deepak and Vinita's comments, there seemed to be this sort of separation between the supply and demand side. I think it's very important to keep in mind actually that supply and demand do not work at cross purposes, nor are they orthogonal to each other. If you see the fourth quarter numbers, the fact that there was basically gross fixed capital formation, which was a 6.5-year high at 34.3%. What did that do? That actually led to construction sector growing by 15%. And all of us know construction sector actually is really important for jobs in the informal sector, especially for the urban poor. So when jobs are created there, obviously demand is created as well. And that was seen in the fact that consumption grew by 2.7% in the fourth quarter. And even the contact sensitive sectors, which had declined by, in the previous 3 quarters, declined in high double digits, actually only declined by 2.3%. So which clearly tells you the evidence of Say's law, one of the most important fundamental blocks actually in macroeconomics, that supply creates demand as well, especially in a country like India through construction sector activity. So I think this is something that, I want to highlight, for want of time, this is something that actually, I mean, it's a subtle concept. I would have loved to actually explain 15-20 minutes on this aspect itself. But let me say that there is a difference between capital expenditure driven fiscal fiscal push versus revenue expenditure driven fiscal push, because capital expenditures, the multipliers are much higher. Multiplier is about 4.8. Revenue expenditures, on the other hand, the multiplier is only 0.9, between 0.9 to 0.98. In other words, there's actually a loss of anywhere between 2% to 10% with revenue expenditure, deadweight costs, while capital expenditures create 380% increase, which basically tells you how taxpayers' money should be invested. And go back to the growth that we have that we witnessed under the Vajpayee era, and following up as well, it happened because of expenditure, capital expenditure and reforms, and that's what we will have as well. So please do think about supply and demand actually concomitantly, do not separate it. That's conceptually not quite right. And some of the interventions through the financial sector that we are doing are indeed very well directed interventions. I've written a piece in the Times of India highlighting this very clearly. Please go and check the conceptual aspects there. Another conceptual aspect that I want to actually bring here is actually the point that Mr. Mahalingam made about crowding out. Here, I would like to direct both Mr. Mahalingam and actually all the audience members to the very, very careful evidence that we provided in this year's economic survey on the crowding out versus crowding in phenomenon. And we showed very clearly this is an argument that is oftentimes made, but in India, we showed there is no evidence of fiscal spending actually creating crowding out. It seems a very, very, very tempting argument to make, but the data does not support it. And I think that's something that we would, so yes, there are some of the other aspects relating to corporate bonds are clearly something that has to be, and what Dr. Mahalingam talked about actually are very important. But I think this crowding out phenomenon is something that actually doesn't seem to, really work out, especially when we make a distinction between revenue expenditure and capital expenditure. And actually, because this is so important in the context of financial sector, let me explain conceptually what is oftentimes the flaw with the crowding out argument. The crowding out argument relies on a pool of savings that is fixed, that is not changing at all, static pool of savings. If you have a static pool of savings, when the government takes out more, every rupee that the government takes out means there's one less rupee for the private sector, and therefore there is crowding out. But a very important presumption that is made in this argument is that when you have, if you have growth, that pool of savings actually grows as well. And there is now very, careful evidence, all the sources are cited in the economic survey chapter, some of these published in the most, leading journals in the world, showing that savings are pro-cyclical with growth. In other words, when growth happens, savings expands as well, and therefore the pool of savings actually, which, the presumption that it is finite or fixed is something that actually is a presumption that is not correct. So when you have a pool that is growing, and when the government takes out, let's say, a rupee today to invest in capital expenditure and thereby really grow that pool of savings from additional growth and the pro-cyclical behavior of savings thereby, then there is actually more for the private sector from the additional pool. And this is what is basically the crowding in effect of infrastructure investment, especially capital expenditure driven by the government. So let's again actually, and it's a very humble request that we must be using, the latest evidence to drive our thinking on economic matters. And that's what actually leads to most careful policy making. And, I would humbly request you all to actually read the economic survey. It is just not enough to say that it's a masterpiece. And I think, if it is indeed a masterpiece, everybody should go and read that very carefully, and actually the evidence that is being talked about there, and so that it can be used for policy making in particular. Now let me, I think with those three clarifications, which I thought was very important, so that we actually do not get, wrong in our assessments. Let me talk about the financial sector itself. In the 2020 economic survey, actually, we had pointed out, and this is something that actually still is an aspect that really concerns me. If you take the private credit to GDP ratio, the proportion of private credit to GDP for India at 58%, we are 1/3 of the OECD average, which is close to 160%. There are sections of, in India, especially in the Northeast, where the penetration of private credit, is almost similar levels to sub-Saharan Africa. Now, this is despite 50 years of bank nationalization. That's a different issue. I'm not going to go into that. But I think the basic point that I want to make is, on the one hand, we have penetration of credit that is so much lower compared to, to global averages. And with some geographies in India actually being at very, very low levels. And at the same time, we also have the phenomenon of really bad quality assets being created. Whenever there is a boom, that's when actually huge NPAs being created. And therefore, we actually have this in the financial sector, this accelerator brake phenomenon, where, when the economy starts doing well, the financial sector presses the accelerator. Oftentimes, actually, lending guidelines, etc., are basically are kept aside and say, oh, we have to compete, and therefore there's just irrational exuberance to lend. And as we all know, the seeds to a crisis are always laid during good times. So that's the accelerator. Then basically you have bad assets, which then leads to brake being actually clamped on. And this accelerator brake phenomenon with the financial sector has been something that has been happening for many decades. Even in 98, 99, actually after liberalization, some of the credit expansion, we had a similar problem as well. So this is not the first time that we actually, before the COVID crisis, that we had this financial sector problem. And I talk about, I will actually highlight why the financial sector is so important, because again, I speak from evidence. I refer to the audience to, the first chapter of volume 2 in the 2020 economic survey on the state of the economy, where we had covered a full section, arguing or asking the question, what is the reason for the slowdown before the pandemic? A lot of people basically say, oh, the Indian economy was slowing down even before the pandemic, maybe something structurally wrong with the Indian economy before the pandemic. And I actually, want to point out that in that, in that section, we clearly showed that the slowdown was primarily because of the financial sector, the bad loan buildup. Because whenever you have bad loans build up, actually, and when those get recognized, recognition itself takes some time, and because there is oftentimes evergreening and also zombie lending, and then you actually have a phase where there's a lot of risk aversion that builds up, and that risk aversion then affects credit penetration, and so you have actually this, this phase where growth severely suffers, and actually, the papers that we cite there, there's work by IMF and also by scholars at the University of Chicago and Princeton University, Amir Sufi and Atif Mia, who show very clearly that unlike problems that stem from the real sector, if problems start from the financial sector, the overhang of that is much, much longer. And, you know, the real economy suffers a lot due to problems that are created in the financial sector. And I think there is the best example of that is, let's just contrast the global financial crisis vis-a-vis the COVID crisis now. Last year, the entire global economy suffered because of the COVID crisis. This year, we're expecting actually a 4.5% growth for the economy. It's back immediately. In contrast, take the global financial crisis. After actually 2009, there was, you know, several governments in Europe actually which went into sovereign problems. The entire effect of the crisis itself continued for a long time, which actually tells you, and I think this is why it's so important that the quality of assets created in the financial sector are paid significant attention to. So the slowdown that we had was an overhang from the bad assets that were created, you know, before 2014, and consistent with the evidence, clearly the slowdown was because of the financial sector problems. It started from the banking sector and then actually spilled over to the non-financial sector as well. So bottom line, based on this, what I want to mention is that the financial sector, we suffer from twin problems. On the one hand, quantity is very low, as I talked about in terms of credit penetration. At the same time, quality is also extremely poor, with willful defaults and the overall NPAs itself becoming a problem. Both these actually need to be addressed by the financial sector. And I think that is by far the most important message that I want to leave the financial sector with is, you know, and therefore, you know, relying on technology is extremely important. And, you know, having myself worked with a private sector institution, you know, before my PhD, I can say it with confidence that even our private sector banks, you know, lag behind significantly in the use of technology for, you know, reducing the problems of adverse selection and moral hazard. And that is something that really needs to be worked on, you know, with the amount of digitization that is happening in the economy today. The banking sector has a phenomenal opportunity with the kind of data that is getting developed to really get, you know, come up with models that can use, you know, intensive use of data to, you know, and both public sector and private sector banks. You know, while our private sector banks have used data and analytical models for retail lending, for corporate lending, yet it seems to be actually mostly soft information. The use of, you know, models actually is still something that needs a lot of work. And yet that is an area where data can really play a big role in assessing not only the probability of default, the ability to repay, but also the willingness to repay. And both of them are extremely important, because willful default is about the willingness to repay, which also is an elephant in the room that the financial sector really needs to actually address using high quality data. So of all sectors in the, you know, in the Indian economy, I think the economy is really looking up to the financial sector to take India forward. I will leave with this, you know, with this parallel, just so that the financial sector actually really takes this as a message for them to, you know, really grow. I'm going to use a cricket parallel. You know, the 1990s cricket team that was led by Mohammad Azharuddin was known for decimating opponents at home, you know, in the home series on tailor-made pitches. But when they went abroad, they had nothing to write, nothing of note that they actually did. In contrast, starting with Sourav Ganguly and then Mahendra Singh Dhoni, the Indian cricket team has actually become one that really does well globally as well. I think for the financial sector, the aspiration must be to move from being, you know, like Mohammad Azharuddin's team to becoming like, you know, first Sourav Ganguly's team and then, you know, Mahendra Singh Dhoni's team as well. It is not enough for the financial sector firms to actually just, you know, command presence in the domestically. Our banks and financial institutions need to become, you know, really need to be counted in you know, globally. After all, we are the 5th largest economy in the world, and so our financial sector actually has to reflect that might as well. Thank you very much for inviting me and for allowing me to share my thoughts. I'd be very happy to take some questions.
I think we are privileged to have heard the Chief Economic Advisor today. His thoughts are so clear. They may not always be, as in economics, um, just what is acceptable to all. And that is what I think is good research. It triggers thoughts. It triggers more research. The issue that he has mentioned about crowding out, crowding in is a highly debatable issue, both in India and abroad. When is it crowding out? When is it crowding in? If the economy is shrinking, is it crowding out, crowding in? These are important issues. And as Chief Economic Advisor of the country, he has in his own economic survey with evidence shown that this is the state. Would it be always the same? Would it be the same in different circumstances? Is what research is all about. And that is what I like about the Chief Economic Advisor, that he touches upon issues which can trigger further research in the country. And I must thank him. And that is why I said his economic survey is a masterpiece, because it opens up ideas and thoughts and opens up avenues and topics for researchers across the country to talk about it. The issue that he has mentioned, and he is an expert on banking. And I'm so happy to note that today, India, and he's very right, India is on the frontier of banking. The OTP which we get when we do any transaction is unique to India, not even in America or England. We are on the frontier of technology. And when the leapfrogging takes place to a $5 trillion economy, it is exactly this frontier that we are leading will take us there. The other, you must have seen RTGS and NEFT, but IMPS is again on the frontier. And therefore, we are very proud that in our country, while we are working on the frontier in technology and banking, we have such bright chief economic advisors who provide us policy inputs. We are actually out of time, but if I have the permission, we can extend it by 5 minutes. There are beautiful and huge number of questions that have come in. I'm going to pose one question to the Chief Economic Advisor and one to Mr. Mahalingam. I know both of you are very busy. I know both of you would have engagements immediately after this program, but I would just like to put this question, and if it's comfortable, you could answer that. My first and only question to Mr. Mahalingam is the idea, and you spoke so very well, Mr. Mahalingam, on the corporate bond market, right from the Patel Committee report. We are struggling to make the corporate bond market vibrant, but we have been so unsuccessful. This government and now you at SEBI are bringing in issues which I think will be successful in making the corporate bond market vibrant, that would reduce pressure on the banking system. So we are very happy that you and the government are doing so well. And here is a question. Is the idea of guaranteeing corporate bonds of specific sectors, not all sectors, of specific sectors, a good idea to help companies in the infrastructure sector in particular to raise funds? And the question to you, Dr. Subramanyam, and I am sure you have heard this question a million times. Do we need rate of rationalization under GST, which is being discussed for some time now? And if so, what are the timelines that we should look for? You know, this is a question which any forum on industry you would go, they will ask you. So may I first request Mr. Mahalingam to respond, and then we'll close from the inputs from the Chief Economic Advisor. Mr. Mahalingam, please.
Yeah, a quick answer from my side is that perhaps the better solution for the whole thing is developing a credit default swap market. I think we have been trying our level best, but there have been a lot of constraining features as far as CDS is concerned. This is one area where we need to work, which will be completely sector agnostic. But then let's assume that we don't succeed in this at all, despite our best efforts. Then we come to a question of whether at least the infrastructure sector, does it deserve at least some kind of a partial credit enhancement kind of facilities? My take on this is, I think we should try it out, because infrastructure is going to be a trigger. It's going to be a mover for the rest of the sectors. If we are not going to bring up the infrastructure sector, perhaps the other sectors are going to suffer. So with all checks and controls, perhaps we can still examine this. So when I talk about a sector-specific credit guarantee, infrastructure sector could be on a priority basis, the rest of the sectors cannot deserve this kind of a mention as the infrastructure sector. But nevertheless, I would still repeat, CDS is something which we need to really work through with all the policymakers putting their heads together.
Thank you. I think you're on top of it, and I'm confident that we'll have a vibrant corporate bond market very soon. Ms. Dr. Subramanyam.
Yeah, thank you very much, Professor Singh. And I very much echo what Mr. Mahalingam mentioned. And I just want to add, one aspect to CDS is actually the very, very important aspect. The netting bill that has been passed by the government is a very important aspect, for derivatives markets, because I'm sure all of you understand that without netting, the capital that has to be allocated has to be on a gross basis. If you have, two counterparties, they can't net their exposures. Then, the capital that has to be allocated actually, is calculated on a gross basis. But when you allow for netting, then, the net exposure between the counterparties can actually be used for, for capital. And that is something which is very important. And the intent behind that was to facilitate the, the development of the, derivatives markets. And I want to mention, and again, oftentimes one hears incomplete assessments which says, oh, look at the global financial crisis, that tells you that derivatives are bad. I think, what we must remember is that fire, and I'll use that parallel, fire, has to be used if we have to cook, and if you have to eat, we have to, of course, light a fire. But if you try and play with fire, obviously fire will actually, it'll burn things. But that does not mean that fire is bad. Fire is basically, all that it means is there is a lot of value from fire. Without fire, all of us will have to die hungry. It's the same way with derivatives as well. And this notion is important. And I will also mention, therefore, that the ability to handle fire and therefore the expertise is something that is very, very important to develop. Derivatives are a sophisticated area, which basically oftentimes use a lot of stochastic calculus for modeling, and pricing and hedging of those. And that is something that must be developed, but there's really a huge opportunity. But I'm really glad that, Mr. Mahalingam mentioned about CDS. Overall, I think this is something, and I will mention, even before I went for my PhD, I was the executive assistant to Chairman FIMDA. In fact, what you see as the FIMDA website is what I had, helped build at that time. And I had remember as a very young youngster being talking about actually derivatives markets, and here we are 20 years later still talking about derivatives markets. So I think now maybe things need to move on this. As for your the question that you asked me, I think that's a it's something that is definitely going to happen. The intent behind the GST, was to, and the original plan was to have a three rate structure. But I think what we have to be very cognizant about is that oftentimes with policy making, you don't want the perfect actually to become the enemy of the excellent. And the GST, the way it got created with actually 5 rates, was basically an excellent move, because now we are seeing, the impact on GST, the amounts that are coming in. But that is, so I think if we, for instance, had insisted, and I think that, with the policymakers then must be given credit for actually, being practical enough to say, let's get it going first and then actually, and craft it better. So I think the 3-rate structure is something that actually is definitely important. Even the inverted duty structures that are there are also equally important to actually fix. But I think the government is definitely seized of the matter. So we should hopefully see traction on that soon.
Thank you very much. We have exceeded the time, and I know both of you are super busy. I must thank both of you for sparing the time and also the extra time that we had to play. I must mention, me and Mr. Mahalingam were in the RBI when the derivatives havoc started in 2005. Dr. Y.V. Reddy was our governor, and we were so scared in our country we will burn our hands with this unknown, unreadable, ununderstandable concept of derivatives. The subprime crisis that happened there before 2008, before the Lehman Brothers happened, me and Mr. Mahalingam knows how concerned we were in the RBI. And therefore, we only allowed the plain vanilla derivatives for some time. You're right. It is fire and it has to be played with by experts. It just can't be left to the children to play with fire and then the whole world suffers. There's a 10-year hole that happened after the Lehman Brothers episode. So you're very right. And I'm so happy that as Chief Economic Advisor, you are able to explain complex things through simple examples, be it cricket or be it the cooking fire. With this,
let me just, maybe allow me the last word on this. The emphasis I had actually was, instead of the glass half empty, which is the way you spoke about children, playing with fire. What I actually want to emphasize is that, this notion that we basically, we'll get burned is something that has to be, really thought about, because without fire, we have to go hungry. And let me add as well, because of this fear, I think the real sector has gone hungry, from the risk management that can come. That is the point that I'm mentioning. I'm not emphasizing as much the fears as the opportunities that are lost because of this fear psychosis that is there. And I think, again, maybe, this is something that Vineet mentioned it very well. Let's focus on the hopes, right? And make choices based on hopes rather than, on the excessive fears.
I totally agree with you. Trained in the Reserve Bank for quarter of a decade, we have been on the conservative side. And you are right. At that point, many of the people in the market were blaming us that if you don't walk, you will never reach the destination. So you're right. It is a half cup this side or that side. But in India, many of us don't use fire at all. We live on fruits and vegetables. So there is both sides of the story. And therefore, we have to be, when dealing with a country like India or the global economics, we have to watch both the sides. I leave it at that. And I think we have had an excellent discussion today. I want to once again thank the chief guest and our special guest for sparing time for us today, and the ASSOCHAM for organizing such excellent discussions. With that, thanks to all the participants, and once again, our guest. Thank you.
Thank you, sir.
Thank you, Dr.
Thank you very much for this opportunity.
Thank you very much.
Thank you.
Mr.
Thank you.
Thank you.
Thank you. Thank you. Well,
Sorry, sir. Good afternoon.
Good afternoon to everyone.
Good afternoon, sir. Sadhu, sir, request you can continue this program, sir.
Dr. Singh is Mr. Sinha's address not there? Closing remarks?
It's already done.
Already done. Okay.
Yes.
All right. Thank you. So good afternoon, everybody, and thank you very much for joining us today. My name is Seshadri, and it's my pleasure to moderate this conversation on the productive uses of financial resources today. I think given the nature of the topic, as well as the very eminent set of panelists that we have here today, I think it's going to be a wonderful conversation. At the outset, I'd like to thank ASSOCHAM, Dr. Singh, and others to have set this up, and also thank them for having us on this panel. So with me today are Shri Arun Mehta, who is the Managing Director and CEO of SBI Capital Markets, Shri Sachindranath, who is the Executive Chairman and Managing Director of UGrow Capital, Mrs. Radhika Rao, Senior VP and Economist Group Research at DBS Bank, and Mr. Satyam Kumar, Chief Executive Officer and Co-founder of LoanTap Financial Technologies Private Limited. So it's a wonderfully diverse panel, And I think, and the subject by itself is a intriguing one and something that I think in the context of today, extremely relevant. So, without further ado, let me turn to Ms. Rao and ask her, as the economist in the group, to tell us, from an economist's point of view, what is productive, and as opposed to something that is unproductive, and perhaps we'll take the conversation from there. Ms. Rao?
Sure. Hi, Mrs. Shishadri. Thank you so much for starting the session. Hi, Mr. Singh and the ASSOCHAM members. Thank you for this opportunity. So I think you started off on a very important note. First of all, let's define what productive is and unproductive is. Certainly, it's you could interpret it in many ways. Let me take a stab at it from three angles. I think firstly, the point will be about savings. We need domestic savings, which we use for investments. Usually when savings are weak, you tend to see dependence on external savings. So I think what are the important factors behind savings? You need household sector, which is a major contributor to our national savings. Households actually make up about 60% of overall savings. Now, of these 60%, what you notice is that not all goes to financial assets, right? Some of them go into physical assets, things like real estate, things like gold. We are one of the major consumers in the world of gold. So amongst the household savings, you would think that 60% goes into fiscal savings, fiscal assets. Now, that one of the ways of looking at where you talk about unproductive financial resources being used in an unproductive way, rather than where you could have channelized most of that into financial savings. The government, as well as the central bank and other national authorities, are making an attempt to steer more towards financial savings, particularly into deposits, and things that are not speculative by nature, so that can be thereafter channelized by financial institutions for further investments. And I think what we need to also remember at the end of the day is that what we have seen in the past 2 years, I mean, I would say past 1.5 years since the pandemic has come, is that these savings really did surge, but thereafter they have tapered off. And if we just take a look at how consumption is going to be, in terms of how strong consumption is going to be coming out of this pandemic, I think it's going to be a bit of a shaky ground. So I don't think income-driven savings increase will happen very strongly over the next 1 or 2 years. But thereafter, I think there has to be, again, an attempt to raise national savings, which will then be channelized towards productive means, particularly through financial means. I think the other interpretation that I can think of is in terms of our public finances, right? I think you talk about how much of total expenditure does the government do, and of that, how much of it is channelized into interest payments. Now, you'll be interested to know that our interest payments, make up roughly a third of general government revenue, meaning states and center put together. And if you compare it with the other countries in our own rating peers, it's very high. So again, here too, if we are setting aside more for interest payments of the past, it leaves us with less resources to spend in the present and the future. And one of the reasons why, you would then argue, hey, interest rates have been falling for the past couple of years. That's true. But what happens is that if revenues are not strong enough, and expenditure remains high, then you still see borrowings increase, and in turn, the interest burden increase as well. So that would be my second interpretation of productive versus unproductive. And the final would be something that the chief CA spoke about just a few minutes back, which is talking about capital expenditure versus revenue expenditure. In our government's expenditure mix, how much do we spend on capital versus revenues? And capital is very important because it certainly has higher multiples. The CEA also cited some data. I've gone through an RBI study which says that every 1 rupee that you expenditure that you do into capital, it increases output by 3x, right? As compared to much lower for revenue expenditure. So the more at this point, the ratio is a bit skewed. It's a 80-20, 80 we spend on revenues and 20 we spend on capital expenditure. But hopefully that mix, if it changes, again, it will bring us back to, give us enough resources to channelize into productive uses. So I would define, I mean, again, this could be taken in multiple ways, but this would be broadly 3 frameworks that comes to me when we talk about productive versus unproductive.
Thank you very much. So if I may paraphrase and try and make it a little simpler,
Sure.
essentially financial savings are productive because they can be used to create capital assets which are useful for the economy. Physical assets by themselves, because they take away from financial savings, are perhaps unproductive. And within that, I guess gold is a big item because we do spend a fairly large quantum of money buying gold. Let me ask a follow-on question. Very often, we live in a reasonably consumerist environment, and very often we are told that this whole culture of consumption is actually unproductive. What is your view on that subject?
Sure. From a growth perspective, depending on personal consumption, comes naturally to us. I think by virtue of having a sizable population and a middle class that is growing, I think by default, consumption has become a very important driver for growth. I don't think that's necessarily wrong because you also see that some of the countries that are more exposed to other modes of engines of growth, particularly the external sector, get deeply affected when there are any global developments, adverse global developments. So, to some extent, if I see from the growth perspective, I would think being dependent on personal consumption isn't necessarily negative. Of course, we need to keep it resilient. Primarily, I think in the current context, what becomes important is that we focus on maintaining the health of the informal sector, because they contribute about half of our growth and employ a majority of people. So keeping that, them healthy, figuratively speaking, is also very important. To my eyes, I don't think we should see that as necessarily a negative. And what I would bring back to the fact that that's again bringing it back to the fiscal part of the story, which I think is important, is because again in the current context we talk about what kind of expenditure has the government done to be able to promote or support expenditure, promote consumption. And I think from that angle, what you see is that it's always seen better if the kind of spending, the support that the government gives is more to do with productive assets, things like capex, again, things like infrastructure spending, NIP, that's the National Infrastructure Pipeline, is another example. Those are better uses of the resources than to purely boost consumption, because it has a very temporary effect. So to Mr. Shadi, to come back to your point, I would think that yes, there is a notion that consumerism might not be the best thing, but I think if you see it from a growth prospect, it does give us a lot more headroom in the face of calamities. But that assumes that we do keep those engines oiled. Particularly the consumption part of the story. That means incomes are protected, job certainty is also available, and that informal sector, which is much in need of these things, is provided policy support.
Thank you very much. So essentially you're saying in a sense that one man's consumption is another man's turnover. I mean, so therefore not having that may not be particularly good. Let me turn to Mr. Satyan Kumar. I mean, when we were talking yesterday, he had a view on this subject. So Mr. Kumar, what would you like to say on this, to add to Ms. Rao on this point?
Sure. And good afternoon, everyone. So essentially, any expenses which we see, we have to see three different angles, and the government or any institution for that matter has to do a very fine balancing act. So it's never unidirectional that we support this one and all. So some of the best case scenario could be healthcare, which serves the societal purpose, which serves everything else, and which creates this thing. Some is just creating more money in the hands of people so that the market dynamics picks up and productive use of those money is created in terms of manufacturing products, bringing services and all to the fore, which in turn brings the job creations and everything. And third, and of course, which is a classic case where I think most of us have always gone back and said that let's put it in infrastructure, because we put in in 1 rupees in infrastructure, we get 3 rupees out of it. So, those are oversimplifications, I would say, and even on the trajectory of on the gold, we have to always look at it that gold is seen as an investment. Okay, gold for the world might be seen as a consumption, but in India, the rural people who do not understand any investment or a complex investment instrument, the housewives, I mean, mothers and the older generation, they have always looked at gold as an investment. So the issue is, how do we create it in a liquid form? How do we use it in further build up? How do we treat it as a saving and not like an expenses? Coming back on the consumption part of the expenses, some of the consumption part of the expenses is also has to be driven to drive a behavior. Okay, so if we are looking forward to really want a environment and the whole the holistic growth, futuristic growth in a picture, and it's not only that if we take an example like in electric vehicles or electric mobility and all. Okay, this consumption is not only going to bring a job or a GDP growth, but it is also going to bring in a behavioral change in the society, people's which is much long term in terms of environment and all. So all I want to say, Mr. Seshadri, and to everyone is that it's not unidirectional. Okay, so consumption, 60% of the economy.
We can't hear you.
We've lost your audio.
We've lost your audio. Yeah, we can hear you. Yes.
Yeah, as I said, when the 60% of our GDP is dependent on consumption, domestic consumption, we can't ignore consumption and say that, hey,
we've lost you again.
Switched off the video.
Audio should be, audio should be going. All right.
Yeah, or we can hear you now. Okay, we'll come back to Mr. Kumar in just a minute. I think the next he touched on a point that I wanted to bring up. I mean, if there is a fair bit of the question at issue, I mean, the issue at hand is how do we increase productive assets. So if you could in some manner make the unproductive assets that we are creating or the unproductive uses of financial resources that we are making today, if they could be converted in some form to productive uses, that in turn will add to the total quantum of productive uses of financial resources. So let me turn to Mr. Nath and ask him what his views are. I mean, how do we do that?
Thank you, Mr. Seshadri, and thank you, ASSOCHAM, for this opportunity. Mr. Seshadri, that given that I'm a part of an ecosystem which is a dedicated lender for small businesses, I think one way to think about creation of productive asset. This is a sector which contributes today 30% of India's GDP, and the Government of India mission is to take it to 48%. This is a sector which provides employment to roughly around 8 to 9% of India's population. But if you look at the largest financial resources available into the country in form of the savings available with both public and private sector bank, and their contribution to the credit to this sector is roughly around 18%. What it tells you that predominantly banks are providing credit only to the extent what is the priority sector requirement is. And it sometimes it amazes me that why a sector which is so large, which provides so much of employment, which means if you provide them more credit in hands of these SMEs, the number of employment which can go up, which will create more productivity across every system, why that is not happening. Now, historically, there has been challenges when it came to the, lending to MSME, but most of it are getting resolved. What it required is to think of the components of the economy which can actually provide the growth engine. While I take our economists' view that consumption is important, but finally that consumption which also drives the growth has to be supported from somewhere. So the manufacturing, and especially the India is not Singapore, which is such a small unit, or where you can just focus on one. India lives in a hinterland, and hinterland with the small businesses, retail trade, wholesale trade, small manufacturers, which will provide the large employment opportunity. So we have to channelize the large financial resources. India is a savings market, while the savings contribution is going down, which is a alarming fact, but still it's quite large. So how do we channelize the financial resources available in the hands of our financial institutions and drive it towards providing capital for growth through SME is a core question to ask.
So let's try and answer that question, Mr. Nath. I mean, essentially what you're saying is SMEs are a very important part of our economy. They provide the vast majority of the employment in the economy. They tend to be very, very capital scarce, and therefore their ability to borrow is also limited, because borrowing is limited by the amount of capital that exists within the entity. And therefore their ability to scale, because they are capital scarce, is restricted. So the answer to many of these problems is to have more capital within the SMEs so that it gives them the ability to scale. So perhaps, Mr. Nath, you can have a shot at trying to tell us how to get them more capital.
Yeah, Mr. Seshadri, I think so you're absolutely right. So I think so the conventional methodology or logic of providing capital in form of credit is to look at the capital available with small businesses. But we have to be, agree that large portion of our small businesses, are sub 10 crore of gross turnover, and even much lower than that, which means that they are still part of an informal segment of the market, wherein their balance sheet in the conventional banking parallels may not be ready to absorb credit at a balance sheet level. The solution which is emerging now, and that's where the whole system has to gear up, is what we call cash flow or a transaction-led credit providers. So there is I of a firm believe that in next 3 to 5 years, India's MSME financing has potential to reach where the consumer financing is, which I call the on-tap financing. Because now there is what we call India Stack 2 is developing. So while I know that most of the SMEs don't like GST as a concept, they don't like the transparency of access to their banking and their returns and all of that too much. But the fact is that the triangulation of the entire GST data, the digitization of the banking, the increased population of the bureau behavior, and multiple linkages of networks would allow these SMEs to borrow for every productive use or every transaction. I'll give you one example, which I have potential to become very large, which is Government of India initiative, which is called Government E-Marketplace GEM. We experimented of building a financing platform. Conventional or historically, the problem has been, think of an Indian Railways giving a 5 lakh rupees order of buying stationery from an MSME. So the MSME has to buy stationery for 3 lakh rupees, print it, and then supply it back to Indian Railways. Now at the point of receiving the order, he needs money to go and purchase material. Now, if he has to go to a bank and get that working capital financing enhanced, it's a 6 months or a 3-month process. But if you are part of that integrated system wherein you can digitally assess and provide him financing just for purchasing that material for that particular order and receive your money back, we will be able to solve the problem of credit for MSME. So my thinking is that if we start looking, if we divorce the entity level capital available with MSME and bring it at a transaction level financing, the amount of capital which can be deployed for growth of MSME of India, this target of achieving from taking them the contribution from 30% to 50% is definitely possible. But it needs a dramatic mindset change and a very large, technological, physical infrastructure. And for SMEs, for them also to behaviorally change and become more digitally oriented and transparent.
Now, that's a wonderful point that you make, Mr. Nath. So essentially, you're saying that technology and the way we do business is enabling us to provide working capital finance in a manner that does not involve a bank anymore. And it can be done at a transaction level. So let's hold that thought and how we can grow that, and we'll come back to that. So essentially, businesses need money for on two fronts. They need money for creating capital assets, and they need money to finance working capital. So we do seem to have a technical solution, which is because of more information being available and because we are all interconnected, we seem to have a solution for working capital financing. But that still leaves the capital asset financing as a problem. So perhaps if I may turn to Mr. Mehta and request him to provide some inputs on how, especially, SBI Capital Markets deals with much larger entities than SMEs. But if you were to think about SMEs, is there some structural solution that's possible for finding capital for these folks?
Yeah, Mr. Shadi, I think, you are right, absolutely, that I look at the 5,000, 10,000, 25,000 crores kind of fundraising. So I may not be the very appropriate person for answering this question, but I'll just give it a shot. Now, what Mr. Nath said is absolutely right. One is basically what you also said, that there is an issue. Ultimately, any company can sustain itself, any firm, company, proprietorship, whatever we want to say, can sustain itself based only on the cash accruals that it has and the capital that it builds up. And SMEs have the entire dice loaded against them when they get into this arena. You see, it doesn't have the economies of scale with it. It doesn't have the reach. It doesn't have the technology. It cannot even employ the best people in the market. So it's a dice which is very, very heavily loaded. Now, how can we circumvent that? We can. Some of the pointers were given very well by Mr. Nath. I think one is the use of technology. The second is debt recovery intermediaries. Ultimately, one place where I slightly differ with Mr. Nath is on the transaction part of it. See, I'll say why, because I've been part of working capital, I've been part of term loan assessments and everything. So on the transaction front, actually, it's a rolling transaction. It's not a singular transaction. And the only place where we follow this transaction system, if Mr. Nath will recall, is under the export packing credit, where we have either a running account facility or we have a export packing credit, which is on transaction to transaction basis. But there also we find that it's very difficult, because one particular transaction may be partly fulfilled, partly the debt recovery may take place, and then from the company's side, from the bank's side, the cost of administering all the transactions is very, very large. So you need people who are following things on a transaction to transaction basis rather than on a macro basis. But technology makes a major difference. Private players make a major difference. Debt collection intermediaries, debt securitization intermediaries can play a very major role. And the fourth and the biggest one, where I think probably we can follow international examples where things are functioning, is government giving guarantees. So government, now that we have a structure where the issues are there. There are a lot of issues actually, and we want to do something about it. I think there are some certain amount of guarantees which are required, which are likely should be higher than what they are right now. I think that could help immensely. So these are the four things that I would say. But one thing, I have a question for Madam Ms. Rao, if I might be permitted to ask.
Please, sir, go ahead.
Yeah, okay. Ms. Rao, I think you made a very good point in the beginning on the economy as a whole, very well summed up. Now, I'll just give you from a banker's perspective again. You see, most of the banks today have a double-digit deposit growth. And most of them, low double digits, of course. And most of the banks today have a single-digit, mid-single-digit advances growth. So, and this has been the case, for quite some time now. So we have a position where the saving rates are very, very adequate, or at least from the bank's perspective, the saving rates are adequate, but there is hardly any demand. The capacity utilizations are hardly 50, 60, 70% in most industries. There is no demand for capital from private sector. The only demand that is coming is from infrastructure sector. So, and that is something where the private sector is not very active. So what are banks doing? Banks are putting money in reverse repo, basically. So how long do you think this whole thing is sustainable, and where do the banks go from here?
Thank you so much, Mr. Mehta. Certainly, I think savings as they are ample in this environment. But generally, if you were to take 5 years to 10 years view, savings rates have been falling in India, particularly households as well. And at the same time, leverage levels were going up. So to answer your question, yes, in this environment, I completely agree with you. In fact, at a bank-wide level, what you've seen, what has happened in the past 3-4 years, like you rightly mentioned, industrial loans pickup has not been that strong, but the retail book in most of the banks has grown. In fact, the retail book at this point is almost as big as the industrial book. So, I mean, it's a different question to ask whether, how healthy is that? Right now, the NPA levels are very low, but that's the kind of mix that has happened. So the hope is that, so ideally, your at this point, savings rates are falling, so are investment rates as well. But in an environment when investment rate picks up, at that time to sustain savings will be very, very important. Rightly to your point, why are the investment rates not high? I think that is unfortunately ties back to the point that two things. Leverage was high, now leverage is better. In fact, I think since last year, many of the bigger companies have taken the move to deleverage, but they still are not confident enough to do, capex. And for that, they need demand to come back. Demand to mean that consumption demand to come back strongly. I think this year we're going to end up with a 9.5% kind of growth, but it is not. It's coming after a deep contraction, so that doesn't give you a good idea about whether consumption is going to come back or not. So I would. It's going to be a long drawn out process. I think we are looking at another 3 to 4 years before which investments can really pick up. When these pool of savings will be very important. Right now, we are in an environment that where savings rates are falling, so are investment rates. So there doesn't seem to be a need for that extra resources, so to speak. But when it does take off, I think it will be very important, because typically what we have seen in the past is that when our investment growth really picks up very sharply, external imbalances also widen at the same time, which is the current account. Theoretically, we say that, the gap is the current account deficit. And in that environment, certainly be very important. I think right now, we have more of productive assets and very less of investment avenues, except reverse repos and the government securities, which have benefited last year as well. So that I completely take your point that it's not a dearth that is a problem right now. It is the dispersal, in the sense that, on the demand side, there isn't ample. But yeah, this is to me the retail book growing as big is something that I'm watching it very closely. I think also are many of the financial institutions as well.
Absolutely, yes. Thank you so much. Thank you so much.
Thank you, Mr. Mehta.
Thank you. So essentially what you're saying is that our aggregated saving rates have been dropping from what 30%. I think, I don't know what the number is right now, but there's been a secular drop, and currently there is no demand for savings at this point in time, which is forcing the money to go into areas where our policymakers probably wouldn't like to see the money going. But coming back to a point that Mr. Mehta made, which is with respect to using government guarantees as a method of quasi-capital for SMEs. So for the first time, we now have reasonably large chunks of money being given to SMEs, subsequent to COVID, in order to keep them afloat. In the credit guarantee trusts have been set up, and a fair chunk of money has gone. But should this be a permanent feature? I mean, in the sense that there should be a mechanism by which their ability to leverage the banks is increased by the form of quasi-capital in the form of guarantees. I mean, what do you think, Mr. Mehta?
Absolutely right. Actually, it should not be a permanent feature at all. I mean, see, when you are I'll not say a startup, but when you have started your company, at that point of time, you perhaps need support for a few years before you can reach some kind of a level where, the growth is self-sustainable. Having been in the banking sector for a very long time, I can tell you that the initial years are the most challenging, because you are learning, while you are actually setting up things. And there are chances, that I wouldn't say, I'm putting it very mildly if I say we don't live in a perfect world. We live in a very, very imperfect world where, for an industrialist, the kind of challenges that are there, there's actually there to be, you need to be an industrialist to really understand. And here, the industry, it's not even an industrialist, it's just a entrepreneur, on a very, very small scale. So perhaps, maybe you give them a reasonable time in which the guarantee is there, and once they break even, then they should be on their own. And in fact, they should also contribute actually to the fund, which provides the guarantee once they are become self-sustainable. I think that is a model that that may work out, of course. And I believe the second part is equally important, that once the SME has found its feet, let them contribute a small amount, let them repay whatever the government has given them initially, and let them contribute to a purpose for other SMEs to be set up in a similar manner. The initial corpus will, of course, have to come from the government, but it cannot be a sustained support throughout their life. It cannot be.
No, I think from the sustained support to the environment as such, individual entities may outgrow the requirement for this support, but every year there is a new crop of SMEs entering the market. So presumably, on an ongoing basis, some form of support or some method of, incrementing available capital is perhaps required. The other point, perhaps, I understand that there are only 14,000 entities in India which are capitalized at over 10 crores. So for a country of our size, 1.4 billion people, 14,000 entities with capital levels over 10 crores seems to be a reasonably small number. How do we get that to grow? Mr. Mehta, and perhaps after that, Ms. Rao can, tell us what she thinks as an economist.
See, actually, it again boils down to where I said, that the ease of doing business. In case we have, less of this regulatory mechanisms, in case we are, let's say, higher on the index of ease of doing business, then anyone, whether it's Mr. Seshadri or Arun Mehta or anyone, would be happy to get into this and if my entire energies are going to be taken up by getting all the approvals in place and ensuring that those approvals stay live throughout the thing. If I have a bad debt and I realize that it's going to take me at least 4 to 5 years to realize that bad debt, it's the entire ecosystem that has to work. So that is the real need to be addressed. So now you have a bankruptcy law. Now, ease of doing business encompasses all of this. Whether I need approvals, permissions to set up a company, whether I need approval permissions to run that company on a sustainable basis, they have to be renewed on a yearly basis. Whether for working capital, what is the ease with which I get the working capital, whether I have to fill copious amounts of details, before getting the working capital and in a very, very slow and inefficient manner, and whether I can sell, recover, I can file cases, I can recover my money in an efficient manner. It is the entire ecosystem that decides on how much the investments that will take place. Otherwise, there will always remain a few large groups, who have understood the ecosystem and who know how to play it, how to run it, and the common man or the smaller investor will not have the courage to get into the system and invest. I mean, so it's something that needs to address the entire ecosystem, not just one aspect of it.
Wonderful. So on that happy note, let's move to Ms. Rao, who is most competent to address the whole ecosystem.
Thank you, Mr. Seshadri. No, I think I might have not much new to add apart from what Mr. Mehta has already highlighted. I think it's very important from various perspectives. I think the basic thing is that they need to be incentivized to grow. I think the rules and regulations should not be set against growth in general. So you'll come back to the major factors of production, capital availability, labor availability. If you were to take on labor, are you, keeping it small, is that more helpful than growing? And what you've seen again in the past few years is that many of the reforms have kind of taken the bend towards formalization, meaning there is a natural tendency for the big to get bigger, and the others are fail to catch up. So I would be completely in agreement with what Mr. Mehta said. Just a few more points to add is basically from the reform perspective. I think that it needs to be incentivized. So bigger the better, and the bigger you get, the lower the regulatory overhang, will certainly incentivize more to come on board.
Thank you. So going back, yeah, go ahead.
Mr.
Yeah,
Seshadri, on that, I'll be on a slightly optimistic note in this particular context, particularly having seen the startup system fairly closely, up close and personal. Lots of new money has been created, and particularly by the newest professionals from both from IT professional, services professional, including the startup founders and all. And I think the capital, I would say that keeping the regulatory overhangs and all simple, the capital availability will not be at the same level of problem what we have seen in past. So I mean, as I said, that market participants are solving it, and starting up a business is no longer as complex or as dependent on a government enablement as it was in past. And every passing year, I think in another 5 to 7 years, if you'll see the pace at which the valuations of the unicorns are built, you will have a huge amount of a capital the way it was created in our neighboring countries and all, which will be available for the businesses to start in a different modes, including venture debts, AIF ecosystems, family offices, besides the VC and PE play. So slightly optimistic over there in immediate terms or a near term.
Yeah, wonderful. So essentially, Mr. Kumar is saying that the market itself will solve the problem. There is a reasonable amount of capital that is available, which is currently going into particular areas of the economy, largely driven by the venture capital funds, et cetera, who are providing seed capital for businesses to start. Let me come back to the point that Mr. Nath made about financing the trade. So the working capital cycle being now being capable of being financed on a transaction by transaction basis. I know Mr. Mehta was of the view that that's a difficult ask, but maybe Mr. Nath can tell us how technology can be used to do this and what makes it so different now that even a banker who's been in the business for 30 years should take a look at it anew.
Yeah. Yes, sir. So there are. I'll try giving it through an example. Think of 5 years back. If you were to lend to an SME, and when a bank goes, when you ask what's your turnover, invariably the customer would say, I have a 1 crore turnover, but by the way, 60-70% of my turnover is not on my books but in cash. So you start making an assessment of turnover. Second, you ask him, what's your expenses? Then again, the same answer, that most of my expenses are in the books, but actually they are not relevant to my business, and that's why my profitability is low. So on the books itself, the eligibility for the customer would come out so low, and then you apply some industry margin, some kind of ratios, and the customer would fail in its credit assessment itself. Now, what has changed from there is that almost a large portion of that assessment of the revenue now is available to you through GST. Because the integrated nature of GST, it's making life very difficult for any businesses to be outside that system. Second, because of digitization of banking, that you can do that assessment and cross-verify between GST and banking. Third, you apply an industry margin and you can analyze what kind of obligations he has and then come to an assessment. That's one portion of that. You can do behavioral analysis by looking at bureau that how this customer behaves, and all of that can be done in matter of minutes. So anything which was being done over a period of 7 to 10 days, now you can do in flat 10 minutes to 15 minutes. But more importantly, as I gave one example, think of multiple ecosystem which we call OKIN or India Stack 2, wherein think of a small SME player selling honey to Dabur. Now, when he sells honey to Dabur, he's so small that he has no ability to create this tripartite arrangement or Dabur accepting his invoice and so on and so forth. But but he has been doing this for last 2 years. He sells honey of say 50,000 to 1 lakh rupee to the Dabur. He receives money after 45 to 120 days back. You have to do only 2 analysis. You pull his GST, you pull his banking, and you can look at the periodicity of his method of payments or his time of his invoicing, what time he receives the money. And today, at a click of a button, you can create a virtual escrow account wherein his next invoice, and this would dramatically change once e-invoicing comes. wherein we only changes the payment account to be an escrow account. So without even Dabur knowing it, when their Dabur would make payment to the account, it would be in an escrow account, and lender can flush out its money first and then release to the SME. So I think that is what I call transaction-led financing. More and more use cases of this we would do. You will see the lending to MSME, and I'm not talking about the capital expenditure, but I'm talking about the working capital financing. It would move from the entity level financing to the transaction level financing. One of the other thing is the risk why the banks and the lending institution has suffered at an entity level working capital financing is behavioral, because most of the small businesses don't differentiate between their personal expense and the business expense. In hour of the need, they will draw money from their OD account and then use it for something else, buying house, marrying daughter, doing something another. Once you move it to a transaction level financing, that risk is taken away. So that's broadly what I say is that we think of, and with Mr. Shah, we are doing this a bunch of work with the State Bank of India, very, very closely, and to launch some of this. So I think so it is moving. Obviously, it is not moving at a pace and speed at which it should happen, but it is definitely happening. And if you allow, I wanted to add something on the guarantees per se as well, if you permit. So on the, we have to all recognize that India's 70% of the banking is still sovereign, is state-owned, which means at the time of the distress or the short of the capital, it is you and me and all of us who fulfill that capital need, because sovereign pays for it. So actually, it's technically, but it's still, banks are risk averse because they just don't understand. Banks and lending institutions generally are risk averse. They don't understand the underlying borrower, which is an SME. If you think of a structure where you say that up to 95% of any loan to MSME, registered MSME India is guaranteed. Government put an additional transaction charge, say 1%, 1.5%, which the borrower has to pay, and that creates a corpus. If you look at all of the time, if my memory corrects me right, there have never been a time that where you have suffered more than 15% overall aggregate loss. And if you divide it between public sector, private sector banks and NBFC, the average would come down even more. So worst case, lending to MSME can generate a 5-6% loss. And if you compensate that by a charge or a levy which comes in the hand of the government, and the additional tax revenue it would generate for the government, this would never be a bad economic proposition for governments to, for next 5 to 7 years, till the time we don't achieve our targeted GDP growth, to provide a full guaranteed scheme for MSME financing in India. Because at the end of the day, you push banks to lend more, suffer loss, and the government again fund the capital, or you do an off-balance sheet capital structure to allow the liquidity to move. Because we have to move this 18% outstanding credit to of the total credit to MSME to 30%. We have to move the 30% GDP participation to 45%. And we have to make sure that this 11 crore people employed through MSME has to go to 25 odd crore. So that society, the overall society benefit from this would be so humongous that governments would actually make money out of by providing 100% guarantee, is my view.
Brilliant. No, I do agree with you that some form of credit enhancement is necessary to make liquidity more easily available. I also agree that with technology coming in, ability to do working capital financing has changed. In our country, it was largely working capital was financed by cash credit. The bills market was moribund. I mean, didn't exist. It was very small. A variety of reasons. There is a stamp duty reason. There is also the fact that there were frauds on the bills side. Mr. Mehta will probably remember, and RBI had put a whole bunch of restrictions on what you do with bills. All of that ensured that we were left with working capital that was financed by banks using cash credit largely. I mean, in recent times, we've been asked to, have demand type loans, et cetera, as a part of that working capital cycle. And technology is changing that and is enabling people to finance particular transactions, which means that capital is now available to fulfill an order. If an order is received, you can fulfill it. But how do we get capital to create the capital assets which will give you the machines give you the capability to get the order in the first place.
100% guarantee scheme, sir.
So 100% guarantee. So now, if we may leave SMEs aside, so we've now come to the conclusion that some form of support is required for SMEs for them to actually prosper and do well. Let's go to the broader economic system and turn to Mr. Mehta again with respect to larger corporates. So with respect to larger corporates, currently financing, the traditional method of financing is what is happening. Very often they are still dependent upon the banks to get money. The bond market is not as robust as it should be. In fact, there was discussion in the morning on the bond market and what we need to do to make it more robust. Alternate mechanisms of borrowing, ESG compliant borrowing systems don't seem to have taken off here as well as they've done elsewhere. So what can we do to make larger corporates access capital cheaper, faster, and in larger quantums, Mr. Mehta?
See, actually, I come back to the original statement that I earlier made, is that right now we keep talking about corporate sector, the growth in the corporate sector is not much. But that again, what Mr. Rao was saying, tied up more to the lack of demand rather than, avenues for us to finance. Because we were discussing earlier that the saving rates are in low double digits, whereas the investment rates are in mid single digits. So actually there is a lack of demand per se. But there are a lot of things, which are happening now. Let me tell you that from where I sit, I see a lot of borrowing happening from, let's say, state governments. Now, what do? They simply, supposing there is so we started some models, from here, where, we advise the states, because the states were having a lot of problem in terms of, having their cash flows. So we started advising states on having a liquor cess, or because that's a state subject, continues to be a state subject. Then there was a petrol cess. Of course, after that the petrol prices went up and there was no scope left for any cess. But some of the states which introduced this cess had ample resources, in terms of their fiscal resources. Now, so securitization of cash flows is one thing, which the states are looking at, which many people are looking at. But again, it's not something new. The second thing which is happening, which in a very, very big way, and which government is encouraging as part of the NIP itself, is the InvITs and the REITs. I think that is something, which is now NHAI had, started the first InvIT, and we were part of that InvIT. After that, it was IndiGrid, and there are so many of them now. Somebody wants to, like if the railways want to go into expansion, they can constitute their tracks, or their overhead electrical power systems into a separate SPV, and then raise money against it and invest for further expansion of the railways. GAIL can do it for their pipelines. So, the InvIT and the REIT format is taking hold in a very big way, and it is much more tax efficient as compared to the other models. And that is what I think the future, in case we are looking at very, very large projects, in case we are looking at state governments or at, the major public sector units in the country, InvIT, REITs, and in case of state government, securitization are what we are looking at as for raising major resources.
Thank you very much, Mr. Mehta. The number of InvITs and REITs is definitely climbing, and doing very well as well, because in a low interest rate regime, I think an InvIT and a REIT is a good place for retail people to put their money. I mean, it's a quasi fixed income kind of bond. I mean, even though it has the ability to at least meet inflation in the future. So it is inflation indexed to some extent.
Absolutely, yes.
With respect to state governments and their securitization, I remember in the old days we used to pay road tax on an annual basis. Now we pay in advance for 15 years, right? So I think our governments have figured out a method of ensuring that you can reach into the future and take the cash today, and that seems to be something that something that is continuing. The reason I asked you this question, Mr. Mehta, was that today there is no demand for money. But when the environment changes and when the prospects and the economy looks really buoyant and people want to put up new plants, new factories, new infrastructure, what should we be doing to make that capital available? And how do we ensure that domestic savings and every other form of savings is sort of channelized into these kind of assets which are productive?
I firmly believe, and I'm sure Mr. Rao will back up this. There is, so far as the private sector is concerned, there is no dearth of capital available with banks to lend. It is just that there is hardly any demand for that capital. Now, where the issue where it comes is on the infrastructure side, where the requirements are very, very large. There also, the banks are willing and able to lend, because I can share with you that we had recently a 25,000 crore kind of requirement, and we were handling this thing and we were able to do it. So as long as the risk is worth taking from a bank's perspective, there is no dearth of capital at all. Banks are parking huge amounts of money, There may be a tenor mismatch at times, but that is something most banks have learned to live with, because we really do not have the 15 years, 20 years kind of deposits which we lend for infrastructure. So there could be an ALM mismatch which banks manage within the permissible ALM issues. But otherwise, so far as it is the risk that is more important than the availability of funds. If the risk is worth taking, the banks have the funds for it. The risk is not worth taking. So I really don't believe that there is any issue on that. Of course, we can always encourage foreign capital. We can always encourage alternative sources of capital. They can be cheaper. We can have structures, where we can create other structures which create a win-win for the industry as well as the bank. But I firmly believe that banks have the capital to lend. It is only that the risk should be worth taking for them. That's all.
Okay. So, Mr. Mehta is of the view that banks are flush with money, capital is not the issue, and no, the what I was trying to find out, Mr. Mehta, is structurally are there some changes that we should be making today to make tomorrow a little bit better when capital becomes a little bit of a constraint at that point in time. But it appears as though that's not the case, and our systems and processes are adequate for the challenge.
Actually, yeah, Raja. See, post the last credit cycle, and believe me when I say this, post the last credit cycle, most banks have made a lot of changes internally so far as risk is perceived. And those are very, very important and very, very far-reaching changes. And the kind of numbers that you see today, because we have already been through an adverse credit cycle. Banks have completely revamped, and I speak from State Bank's perspective also, completely revamped risk. And I think that enables them, makes them more able to, ultimately take maybe larger risks on their books.
Wonderful. So let me turn to ask both Mr. Kumar and Mr. Nath, what are the roles of the banks? I mean, given the fact that we are going through COVID, we are coming out of it now, the economy has started growing again. What else can the banks do, the financial system do, to actually speed up this growth?
Yeah, so on each of the count, if we look at it optically, it might look that the businesses are being supported by adequate capital from the banking ecosystem. However, if you look at whether the credit availability to the SME is concerned, whether the retail credit growth itself is concerned in terms of a loan book and all the stuff, those growths are not standing. Okay, the aggregate growth by RBI report or any other report is either a dip in the retail balance sheets of bank after bank, or it's a marginal 4 or 5% growth in terms of a retail credit which we are talking of. So essentially, what we are saying is that there is a too conservative stance which has been taken by the banking system, whether we look at a TLTR or subscriptions in a lower rated categories, or whether we look at any of the categories where the funds or whether the businesses are suffering, including the MSMEs businesses where they are suffering or individual demand is required. Now, what do I do with a capital which is gravitating only to the top 10 institutions or a top 20 institutions if the capital is not democratically distributed across geographies, or it is not democratically distributed across the risk category, whether it's a newborn business, whether it's a mid-year business, or whether it's a mature business. Today, the entire capital is chasing of the traditional banking system to only and only the businesses which is matured. Okay, what do we do? Does that bring in the same growth? Does it bring in the same impetus into the system? And that is where I think, at the beginning of the panel discussion also, most of us have been coming of the view that there should be a credit enhancement, credit guarantees and all. Why credit guarantees required? Because the capitals are not getting provided to the businesses, okay, which is still at a nascent stage, or which requires a helping hand. Okay, so there is a disconnect between the corners of different from different vantage points. We are seeing a very different world. Okay, so we see a very different world where we see that as basic facility as a medical treatment itself is not getting funded in the same fashion that any other credit, like a priority sector. So like if I'm doing a medical loan for someone who's getting hospitalized in a situation where you do not have too many people who are insured in India, still the insurance penetration is only about 4.5%. Why a medical loan should not be a priority sector loan? Okay, so these are the questions are as basic as for people's survival, people's livelihood. Okay, whether it's a businesses and all, and it's not finding support in when we talk of a larger transaction size of thousands of crores and all. So where is the capital going? That is the question which we all have.
Mr. Nath, would you like to add to that?
Yes, so I would like to take it this way. Banks in India as financial institutions are not mere commercial entities, taking money from one and giving to other, doing the arbitrage and making a spread in money for that. Whether we like it or not whenever a word bank get attached to an entity in India, the general perception is this is an entity which would never fail. And that's why they command very significant amount of trust, and that trust lead to a very serious liquidity which just keep going to them. So you can have many other types of financial institution but the amount of trust which banks enjoy, and that's why the liquidity keep going to them, and that is not going to change in near future itself. And we have also seen that regulator and policy and the government have tried failure, not getting large banks getting failed in India as well. Now, having said that, which means that the largest financial resource in India is available in the hands of the bank, it is upon them that how do they use these resources to expand the everything which is happening in the economy. Now, simultaneously, banks are also risk averse because they are financial entity. There is a capital adequacy. There is a regulator. So that's why we have to figure out an alternative of how this the capital which is, or the liquidity which is available to them can be utilized for multi-dimensional activities, credit, investment, ecosystem, startup of that. And how do you motivate, the leadership of the bank that they can take that risk without being blamed? See, one of the problem is that the differentiation between a bad or a suboptimal credit decision versus other, especially in a country where 70% of the banking is sovereign, has been very, very difficult. But we have to figure out a way wherein, like any commercial entity which is sitting on very large resources, they should be allowed or motivated to deploy capital across different buckets. So unless we don't do and use our banks for this, there is source of capital is not available in many other hands. So that's what we have to do for the banks.
All right. So let's move to another interesting subject. At the beginning of the conversation, Ms. Rao was talking about unproductive uses, and one of the unproductive uses was gold. The government has tried very hard to to get people out of this drug, and it doesn't seem to have really succeeded. And to my mind, it appears to be that, rupee as a store of value hasn't really worked. So when we became independent, we were 5 rupees to the dollar. Today we are 75. And at that time, it was what, $35 to the ounce. And today, I don't know, an ounce of gold, what it translates into in Indian rupees is very difficult to understand. Therefore, from an average Indian's point of view, investing in gold as a store of value has paid off over the last century or so. So the question now is, can we do something with this gold? And what are the impediments? We have the largest stock of gold in private hands. So how do we get that to be utilized? So maybe, Ms. Rao, you can start and then we'll go around the room, and perhaps that's all the time that we're going to have today.
So I'll just keep it crisp, Mr. Seshadri. Certainly, I think there was recognition that a lot of gold is particularly, with households in India. And I think India and China are perhaps the two big countries in the world who command the most. So I think, but gold demand in India has a lot of cultural aspects as well, right? Cultural, sentimental aspects, which goes beyond just, which looks at it from, intergenerational wealth transfer kind of a thing, a tag attached to it. But I think there has been conscious effort by the government as well as the central bank to try and incentivize people to transfer that into financial assets by way of ETFs or by way of gold certificates, and try the returns down to something that's inflation adjusted. So I think that's going to be an ongoing process. I don't think the ones who own gold particularly are going to be the ones. And again, in this environment, I come back to the pandemic again. You've seen a surge, at least some of the financial institutions who have significant gold loans. You've seen that there has been some auctions that have increased because of people needed hard cash and all of that. So my overall idea is that, yes, I think that's going to be an ongoing effort to try and financialize these gold holdings. But because there are beyond just purely investment requirements, most people hold it, or the ones who hold it the most are the ones who hold it for sentiments apart from just investments. So it's going to be a bit hard to break that habit. They don't see it as just something that can be used as a financial assets. For them, it's more a personal usage or a personal investment product. So it needs a cultural shift. It needs various shifts. But then I think the authorities are taking the right stance by trying to come up with innovative products which can get some of this gold out of lockers and hibernation and turn to be more productive. That would be my 2 cents. Yeah.
Thank you very much, Mr. Can I ask Mr. Nath or Satyam to intervene and tell us what they think? How can we get gold out of the lockers and into the productive economy?
Sir, we cannot. So the simple answer is we cannot. Today morning, my wife was telling me that gold price has come down. I don't know why. No, I don't understand your complex financial jargon. I'm going to buy more gold because our daughter is now 20. And in 3 years' time, she would get married, and you don't do anything about it at all, and I have to start buying this. I don't have any argument against it because there is hardly any financial investment which gives you sense of security and growth at a reasonable return available in India. So for a mass public, for a general public or for a citizen of India, there is not a comparative instrument in which they can do this investment. There was a period of time when real estate was very attractive, but that also has lost its sheen. So we cannot do it. So I think there has to be a massive effort in propagating and creating a one single instrument which gives the same sense of security. So as Mr. Rao said, it's about culture. You have to, create a digital jewelry wall, saying pick up a jewelry which you want, buy in digital form, but whenever you want at a predefined price, you get that jewelry. You don't need to hold it to yourself. But these things sovereign has to do this. And it has to do at a scale which is unheard of. Then only you can change this trigger.
No, you have digital gold. XAU is available. I mean, you need an equivalent in India that maybe State Bank of India or somebody can actually make available. It's financialized gold.
I told my wife that why don't you buy this, gold ETF? He says gold ETF is not jewelry. When your daughter would be getting married, you will give her the certificate. Is that what you're telling me, or you will give her the jewelry? Right? I want to buy jewelry. I don't want to buy digital certificate. This is complete nonsense. So you have to convert that into a jewelry, saying digital certificate for a jewelry which is lying somewhere. The day you want it, in 7 days' time, it will be couriered back to your home. Something of that innovation has to be done in India.
Yeah, so absolutely no different views so far as accumulating gold, or the reason why we all have been as a country obsessed with a gold this thing, because it's easiest instrument and you can buy it for 5,000, you can buy it for 50,000. So it's as simple, understood by everyone. So it's a behavioral. Now anything which is a behavioral over a period of years can only be overcome in another way by behavioral traits only. Okay, you cannot change it in any other fashion. What does it offer? It offers easiest way of creating a savings, or easiest way of investing. And so rather than changing that, okay, what I should be changing is that how can I make it as easier, okay, to use also in a liquid form, okay. And when you want to use it in a liquid form, then essentially what you want it to happen to do with it, you want an easy storage, you want an insurance, and you want it to load on a plastic. Okay, so the moment you load it in a plastic, okay, it is available. People will use it for 10 days, 20 days, 100 days. Okay, if I have to take a gold loan, probably I should shy away. Okay, but if it is ready to me on a plastic, I'll swipe it for 10 days. Again, when I need a gold, I'll take back, because all the golds are still finding its way to the locker. The golds are not staying in house. The large golds are not staying in a house. All the golds are staying in a locker. Okay. The small part of the golds should find a sachet way of creating a locker and load it in a plastic, build a credit history, build everything that you want to do, make masses a cheapest cost of borrowing available to them. So, something which is behaviorally done, you do not want to change the behavior. What you want to do is that put as convenient way from a behavioral science way to use it for people. The moment they start using it, it will come into the economy. If they don't use it, it will not come into economy.
Wonderful. So let me turn finally to Mr. Mehta and ask him from his, from his standpoint as the head of SBI Capital Markets, what kind of innovative financial instrument one can look at to make this happen. We can't hear you, sir.
You're talking about the gold thing.
Yes.
Okay. So, actually, I don't know, Mr. Rao may correct me if I'm wrong. I do remember reading somewhere long back, ma'am, whether what Lord John Maynard Keynes had said about gold. So I'm not very sure whether I'm quoting him right, or that gold is the ultimate symbol of human madness. It is dug out from one hole in the ground only to be put into another. I really cannot vouch for certainty that, vouch with certainty that this is what he said. But this is what I recall studying somewhere in school, these lines actually. But I agree with whatever the speakers have said. And only one thing to add here, which is that there is a perceptible change in the attitudes of people. I mean, I'm seeing the new generation. It is not as obsessed with gold as my wife is, let's say. I mean, I'm seeing and the difference is very, very stark actually. So if my wife wouldn't want to sell a single gram of gold in all her life, and that is what I agree with Mr. Nath when he says, that his wife, and she would say exactly the same thing regarding my daughter. My daughter, I find, is the completely opposite of that. She is not interested in gold. She is not even interested in the gold that exists in the family. And I hope and pray that it bodes well, for the future of the country, that the next generation is not as obsessed with gold and will be willing to convert it into productive assets going forward. So that's the way I look at it, sir.
Thank you very much, sir. I think we've had a wonderful conversation today. I want to thank you all for being a part of it and engaging with us in this manner. It's been fabulous. I think we started to understand what was productive and what was unproductive. We went through the full cycle. We understood, we talked about creation of capital assets, financing of working capital, and then we finally finished by trying to figure out what we could do with respect to gold, which is a very large storehouse of value in our country, but it's largely unproductive. And I think this was a far-reaching conversation, and I'm certain that many of our hearers have found it very, very useful. So let me thank you once again. And before I end, let me thank ASSOCHAM for having us here today. And it's as always, the preparations and the systems and everything else associated with it was done brilliantly. And we hope that we continue to have more sessions of this kind. So thank you very much, ladies and gentlemen. Thank you.
Thank you so much, Mr.
Thank you, Mr. Seshadri. Thank you, ASSOCHAM.
Hello. Am I audible?
Yes, you're audible, Mr.
Yeah. I was supposed to give the concluding remarks and vote of thanks, Mr. Seshadri. I am Subhash C. Agarwal, CMD at SSOCHAM. Yeah.
Yes,
so,
sir, please go ahead. I'm sorry.
First of all, I would like to congratulate Mr. P.R. Seshadri, non-independent director, Jan Small Finance Bank, for moderating wonderful session. It's very great. And the discussion you had, what is productive use of financial resources, what is productive assets, unproductive assets, how unproductive assets can be converted in productive assets. And one question raised, one question mark raised by Mr. Sachinder Nath. Whereas small, medium industry is backbone of the Indian capital market, Indian economy, and their problem is they are very they can do business, but they are not getting the required capital. And the only source they are finding it from banks, and banks needs collateral, and banks generally don't lend that much as SME wants. So he has given a very good suggestion. If government gives guarantee and make a mechanism, whereas his mechanism that SME can get capital, and banks will be comfortable to give the advances to them, and that mechanism can be wonderful if technology wise we can and transparency SME is having in their system, and so that the banks can be comfortable to give the advances. So it's a wonderful observation by him. I substantiate because he has given that as a SMA NPA, if you see, would be around 5% or whatever it may be. But if transparency and the technology use is there, government can control, bank can control, and the NPAs also, and those SMEs who are good and who are transparent and who are complying rules and regulations can get advances in a good way. So and company and government will have much more benefit in the form of taxes and employment in comparison to the losses suffered by way of NPH. So it's a very good observation, and government is doing in the Corona post-COVID, they have given guarantees to the bank for advancing to SMEs, and so it's a wonderful discussion. And productive, starting with Radhika Rao, she is Senior Vice President and Economist, Group Research, DBS Bank. So I would like to thank, she has addressed all the questions, productive, what is productive assets, financial resources, and unproductive assets. And she has also answered gold, which is unproductive assets, how it can be converted into productive assets. So in the same way, Mr. Arun Mehta, who is MD and CEO SBI Capital Market, and Mr. Satyam Kumar, CEO and co-founder Lone Tap Financial Technology Private Limited, all have shared their views. And it is gold again, I come refer to Mr. Satinder Nath. He said, in spite of gold, he could not convince her wife what are other financial assets. Mr. Satinder, if you see equity market, in 1980, Sensex was 100. Today it is 53,000. So in 41 years, it is 530 times. If you give compounding interest, it will come around 15 to 6, more than 15% on compounded basis. So if one is not having any knowledge, so one can buy NSE ETF or Sensex ETF or and put money on SIP basis. So I think risk of volatility will be almost zero if you have invested for a longer term, and you are getting a very safe return, more than 15% for a longer period. So so that is my thinking. You can advise to your wife, put your money into SIP in equity market in ETFs. And moreover, sovereign bond fund is giving 2.5% return, and it is digital gold, and money can be invested for 7 years. So Satyam Kumar and they also substantiate that new generation is not liking investment in gold, though it is a store value, it is a fashion, it is behavioral investment, it is jewelry investment, you can say. But the younger generation is least favorable to investing in gold, because gold is a unproductive assets, as well as the return, if you see for a longer term, is around 7 to 8%, whereas equity is beating the inflation and give the real return, which the statistics is telling around 15%. So post-COVID, government has given the fiscal this stimulus in of 6.28 lakh crore, though in fiscal way it is just 50,000 to 1 lakh crore. Only food subsidy they have given 75,000 crore, and this free vaccination around 75,000 crore, and free this loan, and as you said that fully guaranteed to COVID affected sector. So in this way, I fully support that this is a good idea. Government should come with the innovative idea. This type of guarantees should be given regularly, not only after COVID. It can continue, they can continue, and RBI has estimated that post-COVID, the 2 lakh crore is output loss. So our economy has suffered that much second wave, after second wave. And moreover, the economic figure is around that GDP growth should be around 9% to 12.5%. Various estimates are there. I think it's a wonderful session today, and I would like to thank all the sponsors. I would like to thank all the speakers sitting here, and I would like to thank all the audiences sitting here. So it's a wonderful session. I think Mr. Seshadri has done his job very, very well. He has initiated discussion in a good manner, so so that question can be raised and people can understand. Thank you very much. It's a great,
Thank
wonderful.
you very much, sir.
Yes.
Thank you very
Thank
much,
you
sir.
very much.
Thank you, Mr.
Thank you
Agarwal.
very much, sir.
Bye-bye.
Thank you, Mr. Agarwal.
Thank you, Mr. Sheshadri. Bye-bye.
Thank you. Thank you very much.
Thank you. Thank you. Dr. Singh, is this, can we now formally conclude the session?
Yes, please, sir.
Okay. Thank you, everybody, for taking time to attend this meeting. Thank you.